One key to retirement savings and living in retirement that is not addressed by most people is tax planning. You want not only to minimize taxes in your retirement income, but in the savings you put aside during your working life. That's why in this episode of the podcast, I talked with Alan Porter, a certified financial fiduciary and certified tax and business advisor, to give you the answers you need to succeed. My guest today is Alan Porter, a certified financial fiduciary, certified tax and business advisor, and author of Tax Free Retirement Solutions. He's a nationally recognized wealth strategist, best-selling author, and founder of Strategic Wealth Strategies, where he helps everyday Americans access the power of financial tools typically reserved for the top 1%. He teaches clients how to retire completely tax-free, slash healthcare costs by up to 40%, and build generational wealth without relying on taxable assets. Alan also shows people how to escape the volatility of Wall Street and become their own bank using the same strategies the wealthy have been quietly leveraging for decades to stay ahead of inflation, taxes, and market crashes. Welcome to the show, Alan.
Well, I appreciate you having me on. I'm very happy.
Well, I'm certainly intrigued by the topic, and I'm sure my listeners are. I mean, folks want to keep as much of their money as they can, especially in retirement when they're often on a somewhat limited income. So this is a great topic. So we're looking to have a tax-free retirement, but I suspect that this isn't something you start automatically when you retire.
Oh,
What can
no.
people do while they're saving and planning for retirement to ensure that it'll be tax free?
Well, I didn't start mine until I was 58 years old, and I had some tragic things happen in my family. My daughter-in-law died at age 39 of pancreatic cancer, and I was like 99% of people out there, Steve, that thought life insurance was a death product that you had to die to benefit from it. Well,
Hmm.
if not been for her terminal illness rider, her life insurance policy, my son would be bankrupt, who was 100% disabled with no income coming in.
Hmm.
And that was completely tax free, which I knew nothing about. And when she called me, that changed my entire life. January 5th, 2010, changed my entire life. And I didn't buy I had term life insurance before, and now what I have is cash value life insurance, whether it's whole life or index universal life when properly structured.
Hmm.
I bought my first one when I was when I was 58. I'm now 73, and the last one I bought when I was 68. But I've got 8 index universal life insurance policies and three whole life policies for the college education of my granddaughters, because there's not a better college funding vehicle than properly constructed cash value life insurance, whether it's index universal life or whole life. And the reason being is we have no market loss. We're guaranteed by contract never to have a market loss. So we eliminate all the risk in retirement that a 529 plan only compounds. Now,
Hmm.
Steve, think about this. Let's say in 2008 and 2009, you had twins going to college. You had $100,000 in your 529 plan. Well, first off, it's controlled by the government. And if you don't use it for higher education at that time, it was a 10% penalty. But then it is tax free. But if you don't use it then, it is taxable.
Hmm.
But let's say the kids were going to school in 2009 and you just had a 50% loss in the market.
Hmm.
Very few people, Steve, understand. And when you have a 50% loss in the market, it takes 100% gain just to get back to even. We didn't get back to even until the fall of 2015 in
Hmm.
the US stock market. And people do not realize this. They don't realize the distribution. I mean, it's not about rate of return on retirement, it's about distribution of your assets.
Hmm.
When I did this and I found out about life insurance products and what they do, I've dedicated my life. I'm very, very passionate about what I do. Now, I used to have my Series 63 where I did assets under management, stocks and bonds. I don't do that. I have people that I work with on my team that do that. But I have a team of experts and specialists. And what I mean by that, Steve, let's say that I'm your family doctor. I can treat you for minor illnesses, minor injuries. But if you want your knee operated on, you want an orthopedic surgeon, correct?
Right. Hmm.
Well, that's what I have. I have specialists, top tax specific attorneys, CPAs, and other specialists in their fields. And we collaborate to come up with solutions for people's problems, financial problems. We, uh, we show people how to think outside the box of conventional financial planning. Show people how to reduce, possibly eliminate both debt and taxes. We also show people how to possibly set up a tax-free retirement that can possibly, not possibly, it does. It eliminates or mitigates all the risk in retirement that many other financial vehicles only compound.
Mm-hmm.
Let me ask you this, Steve. Do you understand what sequence of returns risk is?
No, that's a new one on me.
Well, I've got multi-millionaire clients that they're 75, excuse me, they're 65 to 70, and they've got hundreds of millions of dollars in their stock portfolio. And their financial advisors, who are fee-based, are supposed to be a fiduciary, have never told them about any of the risk in retirement. But I'll give you a perfect example. Let's say that you have $1 million in your stock portfolio and you go to retire at age 65, okay?
Mm-hmm.
Well, that's $40,000. If they say a 4% distribution rate is a safe distribution rate, indexed for inflation at 3% to last for 30 years.
Mm-hmm.
Well, first off, all of my financial strategies go to end of life or age 120.
Mm-hmm.
But that 4%, like I said, it goes for 30 years. It's not guaranteed. All right. What happens if you have a 10% loss in the market that first year? Your $1 million now goes down to 900,000 minus the $40,000 you took out, minus the fees you pay that financial advisor, whether you make money or not.
Mm-hmm.
And then what happens in the next 2 to 3 years, if 2008 happens again, and we've got a 38 to 52% loss in the market, you will be out of money around the 5th year. In a nutshell, what sequence returns risk is, Steve, is if you have a loss in the market, when you go to take money out in the first 2 to 3 years, a 10 or a 20-year period, you will be out of money anywhere from the 5th to the 9th year. And people are not prepared for this. The average 401k, Steve, only lasts, I think it's 5 to 7 years now.
Mm-hmm.
And this is what really gets me on the 401k. We've been inundated by Wall Street and fee-based advisors that the only way to save for your retirement is through a qualified plan. Well, first off, Ted Binion, the guy that invented this in 1973, I've even got him on video, said the 401k is a disaster and needs to be replaced. Mm-hmm. Because what happens is 58% of the people do not even think there's a fee on their 401k. All right. Mm-hmm. The average fee in a 401k is 2.99%. And that's by Forbes magazine and Lap Times. People have less than half of their money when they go to retire, and then they're hit with taxes anywhere from 20 to over 55%. And they're not prepared for it. So what I want to do is I want to insulate people from taxes. I want to insulate them from the risk in retirement. The number one fear in retirement is running out of money before you run out of life. I can eliminate that risk. I can eliminate sequence returns risk. I can eliminate market risk. I can eliminate government risk. I can eliminate the taxation of Social Security, the means testing for Medicare Part B, and the taxes on IRMA, which will be in the thousands of dollars per year. People don't understand this. Mm-hmm. I can protect you from lawsuits, liens, and judgments. I can protect you from probate. Obviously, you know what probate does, but many people don't. The entertainer, Prince the Entertainer that died a few years ago, he had no exit plan set up, no will, no trust set up. And his family are probably going to get anywhere from 20, maybe 25% of that estate because the government comes in, confiscates the assets, sells the assets to pay the taxes on the estate. And the attorneys will get 6 to 12% of that for legal fees. And they're not prepared for this. What's the Joe Robbie Stadium in the 70s? He owned the Jets. I'm not the Jets, but the Dolphins. Mm-hmm. They had no plan, and their family got very little of that $400 million he was because they sold the team and the stadium to pay the taxes on the estate. But this is what I show people what to do, because probate, in my estimation, it's a lawsuit that's initiated by you that you're going to pay for and you're going to lose. And we can eliminate probate for people, but other things, just like market risk, when you eliminate market risk, when you go to retire, it's not about your rate of return. It's about distribution of your assets. Mm-hmm. And when I talk to people, I mean, they've got millions of dollars in their stock portfolio, and I said, are you diversified? Well, yeah, I'm diversified. I've got this stock here, that stock. No, that's not diversification. You need to diversify your assets. You need to have, a stock portfolio. I'm not against a stock portfolio at all, but also you need to have guaranteed income. You need to have tax deferred income. You need to have tax free income, which is the best kind at all. Because think about this. Let's say that you've got I had this one guy. He's a multimillionaire, and this was back in 2019, I believe.
Mm-hmm.
But he had $1 million in an IRA. I said, "What are you going to do with that?" He was 65 years of age. He says, "Well, I'm going to will it to my grandson." I said, "Well, you can't do that." And I said, "Well, first off, whose is that?" He said, "Well, it's mine now. I think I made him mad. There's my name right at the account." I said, "No, but you have a partner in this. It's called Uncle Sam." And at that time, since it's qualified income, it's paid as ordinary income tax. So he said 39.6 or whatever it was back then. But now, because of the Secure Act a couple of years ago, he cannot will that to his grandson. It has to be like his wife or disabled person that qualified plan can go to. But if he doesn't do that, it's got to be spent in a 10-year period, and it's taxed at your beneficiary's tax rate, not yours. So I said, well, he asked me, so what are we going to do, Alan? I said, well, first off, let me ask this. What about required minimum distribution? Now, he's 65, Steve, and didn't know what it was.
Mm-hmm.
I said, do you realize if you don't take the amount of money that the government says, it's going to be a 50% penalty plus all the taxes? You'll have less than 4% of your money. He said, you've got to be kidding me. No. I said, by the time you figure state tax, federal tax, possibly IRMA tax, you're going to have less than 4% of your money. He says, well, what are you going to do? I said, we're going to pay the taxes on it. He said, well, I don't want to pay taxes. I said, nobody wants to pay taxes, but we're in the lowest tax bracket we've been in 70 years. I said, we'll take $200,000 a year for 5 years in a row. The last year we'll take either less or more, it depends what the market does. And we're going to pay the taxes on it and turn it into a Roth. Now, I want you to think about this. Now, we've got this $1 million. Let's say it just didn't grow or whatever. Well, we have that $1 million, but now everything is growing tax deferred, will not affect the taxation of Social Security, the means testing Medicare Part B. For your lifetime, your son's lifetime, and for your grandson's, when he wants to retire and he has access to this, and this can be generational income if it's handled right, not just for beneficiary. It can be generational income. And he said, Alan, let's get it done now. So we did that. The other things too is I show people how to save tremendous amounts of money in healthcare. And I've really got involved in this between what's happened to my family and what I've learned in the last couple of years. I have a preventative health and wellness program that is no net cost to the employer, no net cost to the employee. Now, you have to have 10 W-2 employees to qualify for this. But the employer will save approximately $1,200 a year in FICA taxes. It's a Section 125 code, cafeteria plan of the tax code. But the employees, now understand this, Steve, the employees will get anywhere from $50 to over $100 a month extra in a paycheck. They have 1,100 prescription drugs that are zero copay. That's 20 to 30% of your healthcare costs right there.
Mm-hmm.
They've got whole diabetic packages all put together. It comes to you in the mail. Mm-hmm. We're at 70,000 pharmacies across the United States, 90% of all the pharmacies. We have the #1 healthcare app in the United States with rated by J.D. Power and Associates. And employees with this preventive health and wellness program have an 8% higher production rate and a 7% higher retention rate. So what we do for the employer is not only do we give them more money in saved FICA taxes, but they increase revenue with the 8% increase in production. And now they have less problems with retention and recruitment of qualified individuals. And the employer is also able to use all of these benefits, except for one. The employees get a accidental insurance policy to cover all kinds of accidents. Now, the employee is only available for that. The rest of the people, their family up to age 26, can use this app. It's called the Welllution app. And it's got, like I said, it's got the #1 telehealth app on the industry there. Now, think about this too. How many lost hours because of sick people? Let's say you're at work and you start to feel bad. You get on that phone within 15 to 20 seconds. You're connected with a qualified individual, whether it's a doctor, a PA, or somebody. You start to tell them their problems. They'll write a prescription. They go to the pharmacy and they start taking a prescription that night. They may not have missed work. But what if they sit there for 3 or 4 days and get sick worse and worse? The production goes down, and now they have to take off time to go to the emergency room or see a doctor and get the same thing. But the problem is you're saving so much time because 60 to 70% of people do not have to go to the emergency room for the doctor. They just need to talk to a qualified individual and let them know what's wrong with them. And another thing we have on this, it's a biometric scanner, Steve. It scans your face within 99% accuracy within 15 different areas. Blood flow, heart attack risk, stroke risk, diastolic blood pressure, it goes right on down the line. Well, about 4 months ago, this lady was not feeling well. Her husband was the employee. He scanned her face, comes up with a bunch of numbers. He didn't know what it was. He pushes that button within 15 to 20 seconds. A qualified individual looks at the readings and said, get her to the hospital. Looks like she's having a heart attack. Probably saved her life. But there's all kinds of things it's a plethora of benefits for all of these people through counseling programs, through accidental death, accidental insurance, the 1,100 prescription drugs. It's just a beautiful thing. But it's a preventive health and wellness program. You don't even have to have a healthcare program for this. But we have a healthcare program that is 20 to 30% less than the big four, Cigna, Aetna, Blue Cross Blue Shield. And it's the same thing. But see, those companies, Steve, my understanding are in lawsuits right now because they're PBMs. The pharmacy benefit managers have been overcharging companies and people by over 20 to 40% for years. And now they're getting caught with it. And they're not understanding. But that's the healthcare portion of it, because I can save people a tremendous amount of money on that. But
let's break that down a little bit. You've given us a lot of information on different topics, but let's step through it so our listeners understand what they need to do. Okay, so you've covered most of the questions, but let's break it down so our listeners know what they need to do. My original question was, before people retire, in doing their investment and retirement planning, what can they do now to work towards a tax-free retirement? You mentioned whole and universal life policies and investing in those, because when the money comes out, as I understand it, it's tax-free.
Yeah, tax-free through IRA code 7702 and 70E.
Okay. So in addition to a 401k or an IRA or some of the more traditional investments, at the same time, if they're investing money in a whole life or universal life policy, by basically paying more than the premium, right? They're basically investing that money.
They're max funded. But here's the thing: it's not it's not a universal life. It's an indexed universal life.
Okay, what's the difference?
When we use indexed universal life, first off, we're guaranteed by contract never to have a loss due to a market downturn.
Okay.
Because we use indexing strategies such as the S&P 500 index, the Russell index, the Euro index, and we may not get the whole gain, but we may get anywhere from 70 to 90% of the gain. But we have a zero floor, guaranteed by contract, never to have a loss. Now, like I've got 5 of these index policies for my retirement. I could have 3 years ago taken out approximately $105,000 a year tax-free for the rest of my life. And a death benefit at that time was $1.5 million that I can use for my long-term care. 90% of that tax-free I paid for pennies on the dollar, that I can mitigate or eliminate long-term care risk. And then if I don't use it, it's going to be a legacy for my family as it continues to grow, because I don't need the money now. I just leave it in there and let it grow.
Right.
But
so you either have the death benefit or you sell the policy and get the money up front for long-term care costs.
Well, here's the thing. I would sell the policy, because your death benefit, you can use 90% of that death benefit for long-term care and still have access to everything else that goes along with it. Let me say, it's like Susie Orman and Dave Ramsey. They always say, well, now I agree with 50% of what they say about staying out of debt and keeping minimum use of the credit cards. But what I don't agree with them, they always say, Buy term and invest the difference. That is the worst advice I've ever heard. Because first off, 99% of people are not going to buy term and invest the difference. They're going to buy term and they're going to spend the money. But I asked him, I said, what if I can show you a financial vehicle that can be a tax deduction when properly structured? It grows tax deferred. Distributions are tax free.
Mm-hmm.
It does not affect the taxation of Social Security or the means testing Medicare Part B. It is the greatest wealth transfer vehicle available out there, bar none. You can take advantage of the market when it's down. You become your own bank, paying yourself compound interest instead of financial institutions. And I'll get to that in a minute. It's also the greatest college funding vehicle available. It's a legacy planner. And of course, the tax-free death benefit. And everybody says, well, there's no such vehicle. I said, yes, it is. It's properly constructed cash value life insurance, where it's whole life or index universal life. Because there's no other, it's the greatest, in my assessment. I used to say IRS approved. I got trouble for that one. But I say, okay, it's the greatest tax code approved, tax-free retirement system available today, bar none, because it will eliminate or mitigate the risk in retirement that all these other financial vehicles only compound. And why people don't know this, I know why people don't know this, because they don't know what they don't know. And these financial advisors out there are not licensed. They're not educated in these insurance products because they're concentrating on finding you the best possible stock portfolio investment.
Mm-hmm.
So I mean, there's
that life insurance policy, as I understand what you're saying, is that the two big advantages are the growth that it has in the money you put into the premium payments. That growth is tax free, and because you're indemnified against a loss, if your other investments have a big hit, you can use that money to bridge the gap until you recover. And so that's a huge advantage in doing that.
Well, I mean, it's just like, people say, well, Alan, what if the insurance companies go under? You lost all your money. I said, first off, and I got in an argument with not an argument, it's a debate with one of these wealth advisors out in California. And he said, well, Alan, why do you like annuities? I say, I like fixed and fixed indexed annuities because I do not like variable annuities because they're tied to the market. Their fees are over 4.5%.
Mm-hmm.
But I said, what you're telling me, and I'm telling you, I said, I like these annuities because they give guaranteed income. And the guy says, well, what if that insurance company goes under? You've lost all your money. I said, well, obviously you don't know what you're talking about because the states control the insurance companies. A tax goes to the insurance companies from the premium that you pay. And let's say here in North Carolina, State Farm sells 10% of all the policies, okay? And then say Pioneer Mutual or somebody comes in and goes bankrupt in a couple of years. Well, that pool of money that the state has will pay for any liabilities that Pioneer Mutual had.
Mm-hmm.
And if there's any money left over, then State Farm, since it sells 10% of the policies in North Carolina, has to pay 10% of what's ever left. If they don't do it, they can't sell life insurance in North Carolina. Insurance companies look out for each other. Now, I know this for a fact, and I know no insurance company that's gone under, that it's been recovered by another insurance company. But I know of thousands of stocks and businesses and banks that have gone under. And I learned this exclusively. I spoke at Nashville at a conference and attended a seminar there. And I was flying back with a banker. She was the head of the mortgage division at Truist Bank in Atlanta. And I handed her one of my books, Wealth Beyond Taxes, another one, Debt-Free Retirement for Life. And she said, Alan, I mean, they're really short reads. And she looked at them. She said, my financial planner, I've been with them for 25 to 30 years. They never told me about any of this stuff. I said, I understand that. Now, she'd give me 100 referrals now. But I said, let me ask you a question. How much money does a bank have to loan out $100 million? She said, well, I think about $12 million. I said, do you realize that a life insurance company, they have to have, if you write a policy on UST for $100,000, they have to have $100,000 in their general account, plus an 8% surplus. All my companies have over 100% surplus. Banks are over leveraged. Think about how many loans can go bad in that 100 million.
Mhm.
They're over leveraged. But when I talk to people about that and I show them the safety, well, life insurance companies have been around for hundreds of years. They're the only financial entity or vehicle that paid dividends during the Great Depression. And they're going to be around for hundreds of more years. The same thing with life insurance products because they do annuities, they do cash value life insurance. All life insurance is great because it protects the family. And it's gotten a bad name from a lot of people because the policies are not built right. You've got to build the policies right to make sure that you understand what the client wants and how these policies are going to perform.
Mm-hmm.
But when I think about some of the other things I do for retirement, just like what you do before you get to retirement, like putting in cash value life insurance. If you're getting a match, now I'm not against the 401k. If you're getting a match,
Mm-hmm.
put the match in. That's fine. That's free money. But anything over that, and I can still show you in my calculation and in my calculator how even if you got a match, a 20% match, life insurance is going to beat it. Not my thousands. It's going to be about millions of dollars over a 30-year period. And people have no idea about this stuff. But the number, that's what I love about life insurance. The numbers don't lie.
Mm-hmm.
And,
What?
Go ahead.
No, I was just going to ask you. So we covered the life insurance issue. What are your thoughts on Roth conversions as far as moving money from a traditional IRA into a Roth IRA to prepay taxes and then have use that as part of a tax-free retirement?
Well, that's a great vehicle.
Mm-hmm.
Again, thinking what I said about that one multimillionaire, but there also think about this. There's so much money, some part of your money that's not going to be taxable, even if it is taxable money. Like you can go up to $44,000 of provisional income,
Mm-hmm.
and that's whether it's a 401k, a stock portfolio, whatever.
Mm-hmm.
You go over that, being married, 85% of your Social Security is going to be taxed.
Mm-hmm.
But like the standard deduction, you can have a portfolio with standard deduction. You're not going to pay taxes on that.
Mm-hmm.
Anything that you have you don't have to pay taxes on it. But people don't understand. $44,000 is the magic number. I think it's going to change next year. But if you go over being married, you go over $44,000 of outside provisional income, you're going to be hit with taxes about 85% of your Social Security. In today's tax bracket, that puts you in the 12% minimum tax bracket, approximately 10.13% effective tax bracket. Provided taxes don't go up, you're writing a check to Uncle Sam for over $6,000 a year. And people don't understand this at
Yeah.
all. Another thing that you can do before retirement with these cash value life insurance policy, like I said, you can become your own bank.
Mm-hmm.
And I'll give you a perfect example. Have you ever heard of effective interest cost, Steve?
And not that term, no.
Well, most people have no idea about it. And I had a gentleman, he's a friend of mine. He retired from the military at 42. And I showed him my tax-free retirement system using an index universal life. And he says, Alan, I want to do this. I said, well, first off, how much debt do you have? He says, well, we bought a new house a couple months ago. I got a couple car payments, a loan, and a credit card. I said, okay, I want you to fill out this paperwork, and we'll do a Zoom conference the following week. So he said, okay. Well, he did. And I said, first off, you got $461,000 in debt. That's not your problem. The problem is the 49. Oh, and before that, he told me, I said, what's the interest rate on your mortgage? He said, it's 2.75. I said, that's great. I said, but the problem is you have $461,000 in debt. That's not your problem. The problem is the 49.76 effective interest cost you're paying on that 2.75% mortgage. And he said, Alan, how is that possible? I said, because it's not going to get down to the 2.75 until the last couple of months of the mortgage. I said, you got a credit card here that's over 90% effective interest cost. And most people's credit cards, if they don't pay it on time, or if they delay their payment, minimum payments, they're anywhere from 80 to 95% effective interest cost. I said, even though you've got great credit, your average effective interest cost is 46.23%. I said, you're contributing to a 401k right now, aren't you? He said, yeah, and I lost 10% last year. I said, how much money are you putting into that? He said, $1,000 a month. I said, okay. I said, what financial vehicle are you contributing to that gives you a 46% return on your money? in your 401k or anything else? He said, absolutely not. I said, okay, well, take that $1,000 from your 401k you're contributing right now, and we're going to put it in a whole life insurance policy and use a tax-free bucket of money in a whole life insurance policy. And how long does it take you to pay your bills off the way you're doing it right now? He said, 20 some years because we're paying extra on the mortgage. I said, that's what a lot of people do. But I said, with our policy, with our tax-free bucket of money, we're going to have all your bills paid off 14.17 years faster. We're going to save you $73,000 in interest. And at the end of the 10th year, there's going to be over $130,000 in a tax-free bucket of money that you become your own bank. You'll never have to go to the bank for college education for your kids or buy a car or anything else. And your death benefit at that time is $400,000 to protect your family of tax-free money in case something happens to you. Now, I want you to understand, you'll be 52 years of age. You have to put no more money in this insurance policy. You can if you want to, but you don't have to. I've showed you how to become your own bank. You'll never have to go to the bank for college education for your kids or whatever. And by the time you're 65, there'll be over $250,000 in a tax-free bucket of money that does not affect the taxation of Social Security, the means testing for Medicare Part B, and you're protected from lawsuits, liens, and judgments, and you avoid probate. It eliminates or mitigates all the risk in retirement. Mm-hmm. And he says, Alan, he said, you made a dream of mine come true. But why don't people know this? I said, it's not rocket science. It ought to be taught in high school. And it should be. But I've got doctors with PhD degrees in accounting and finance, have no idea what I'm talking about. Some of them ask me to teach their classes. And I do. I mean, I've spoken at Harvard. I've spoken at West Point. I've been published in over almost 1,600 publications across the United States. I've got my own national podcast. 2023, I was selected as Who's Who in America for top excellence in financial advice. And last year, I got selected as one of the top 100 people in finance. Mm-hmm. And but this is just education for people. And when you do that stuff before you retire, man, I wish I'd have known about this when I was 40 years old. And like I said, I didn't do this till I was 58.
Wow.
But what a change. What a change. And when people find out about this, they're always thinking about, I ask people, I said, why do you contribute to a 401k? They say, well, Alan, it's a tax deduction. I said, no, it's a tax compound. If you think taxes are going to be lower when you go to retire, you better have another thing coming. We have the highest, what are $37 trillion in debt right now? Our unfunded liabilities are over $217 trillion for down the road. It's already been proven by a Congressional Budget Office report. By the year 2030, if we don't raise taxes by 50%, we can't even pay the interest on the debt. The country will go bankrupt. Hopefully things change. But right now, that's just what it looks like.
Wow. And I understand also when you talk about being your own bank and using these insurance policies, I mean, you can take the money out, but you can also use it to finance things. You can borrow against it pretty much open-endedly, as I understand from talking to a previous guest.
I have not been to the bank in a decade and a half when I learned how to do this. Okay. I'm going to give you a perfect example. Let's say, and I just borrowed $50,000 to buy a car for my wife here about 6 months ago. Mm-hmm. Let's say you have $100,000 in a cash value of your life insurance policy, but your death benefit's $1 million. Mm-hmm. All right. You're going to borrow from yourself from the cash value. First off, that cash value, nothing happens to that. It continues to compound. Mm-hmm. Okay. The only thing that happens at $50,000, it's a lien against the death benefit. Now it accrues interest, but the only person that's going to suffer could be you for long-term care or your beneficiaries. You don't even have to pay it back if you don't want to, but you have structured loan payments. But I want you to think about this. All right, if I got that $50,000 from a bank or financial institution at 0% interest, I would pay them $1,000 a month for 50 months. Now, if I did that, every time I paid that $1,000, that money's lost to me. It will never compound for me again, but it will compound for the financial institutions. That's one of the ways they make money. It's crazy. Mm-hmm. But here, now get a load of this. When I pay myself back, not only do I have my original $100,000 compounding, every time I put that $1,000 in per month, now I'm going to have tens of thousands of dollars more in my cash value, and my death benefit continues to increase. Mm-hmm. When people learn to do this, I think everybody should do this. but you've got to be educated on how to do it. You just can't do it in the first year or 2 years. You got to build some, some cash value up in policy. But
Mm.
once you do that and become disciplined and pay yourself back, it changes people's lives. There's no more effective interest cost. I
Mm.
haven't paid effective interest costs in over 15 years. So I haven't been to the bank and borrowed any money.
Well, it's a lot of great tips, between the leveraging of life insurance policies, the Roth conversions, and things like that that you can do uh, with this to minimize your tax. You also gave some great information on how to cut healthcare costs in the short and long term. So I'm sure our clients will benefit quite a bit. Tell us a little bit about what you do, how you help people, and how people can get in touch with you if they want your help.
Okay, well, I want to bring one other thing out. I'm a certified tax and business advisor, and I just got back one of my clients recouped taxes he's paid over the last 3 years of $2,280,000 this year.
Hmm.
And our tax strategy just came out. They'll be in the second week of March because we vet everything.
Mhm.
But there's all kinds of tax strategies out there. Do you realize that 93% of businesses overpay their taxes by 35%?
Hmm.
That's a lot of money. And I can
Yeah.
show people how to get that money back. Recoup past taxes, reduce or eliminate future taxes. But this is all about education. I don't charge a fee for my counseling sessions. It's all knowledge, and everybody needs to have this knowledge, not only for their present financial situation, but their future, for their family, and for their legacy. And they can always call me at 910-551-1046. My website is www.strategicwealthstrategy.com. Now, Steve, I have a plethora of information on there. I've also got a YouTube channel on there. It's Alan Porter YouTube, but I got over 500 videos, and they're anywhere from 26 seconds to 18 minutes long. But they all educate people on what they don't know. And then you can always email me at strategicwealth, the number zero at gmail.com.
All
I
right.
had one guy, on a podcast. He said, Alan, when are you going to retire? And I just told him, I said, listen, as long as I have a healthy mind, I'm never going to retire because I love what I do. And I have a team of people built around me because everybody asks me, well, Alan, what happens when you pass away? I said, that's why I have a team of people. We're here to take care of the client.
Right. Well, great. So not only the information that you've given us today in the podcast that the listeners can benefit from, but also website can give and your YouTube channel can educate them even further if they have other questions and want to try some of your strategies, and they can always contact you. So I'll have all those links in the show notes for folks to check out. So thanks for coming on the show, Alan.
Well, Steve, I appreciate it. And thank you for having me.
Absolutely.